Imagine you woke up one morning with $100,000 burning a hole in your investment account. You want to put it to work, not for a quick flip, but for real, sustainable growth over the next 20 years. Which ETF do you choose? Today, we're going head-to-head. SCHD versus QQQ versus JEPI. And we're going to simulate what happens over 2 decades. Let's start with the fundamentals of each strategy. SCHD, Schwab U.S. Dividend Equity ETF, focuses on high-quality dividend-paying U.S. companies. It tracks a dividend-weighted index and selects firms with strong balance sheets, consistent cash flow, and sustainable dividends. SCHD's long-term average annual return since inception is around 12.04%. Its expense ratio is extremely low, just 0.06%. That combination makes SCHD a favorite for investors who want both yield and capital appreciation. The fund holds around 100 stocks, carefully selected through a rules-based approach that emphasizes dividend sustainability and quality metrics. Then there's QQQ, the Invesco ETF that tracks the Nasdaq 100. This fund is essentially a bet on technology and innovation. It's heavily exposed to tech giants like Apple, Microsoft, Amazon, and Google. QQQ offers high growth potential, though with more volatility. Its expense ratio is about 0.20%. Because of its tech-heavy exposure, QQQ has historically outperformed many broad market ETFs during bull markets, but it's also taken deep hits in downturns. The concentration in the top 10 holdings means that a handful of companies drive most of the returns, which can be both powerful and risky. Finally, there's JEPI, the JP Morgan Equity Premium Income ETF, launched in May 2020. It uses a covered call strategy combined with high-quality equities to generate monthly income. It's designed to provide current income with some potential for capital appreciation. Its expense ratio is relatively higher, around 0.35%. The payoff? JEPI yields consistently, offering a smoother stream of cash flow, but its growth will be capped by the options it sells. The fund actively manages both its equity holdings and option overlay, making it more hands-on than traditional passive index funds. Now let's set some assumptions for our 20-year simulation. We'll begin with a starting principal of $100,000, assume dividends are reinvested for SCHD and QQQ, while JEPIs are partially reinvested. We'll also assume no additional contributions. This is a pure lump sum test. Based on historical performance and forward-looking expectations, SCHD can reasonably be modeled at 10% annualized returns, QQQ at 12%, and JEPI at 7% when combining yield and moderate growth. If you invest $100,000 in SCHD and let it compound at 10% annually with full dividend reinvestment, by year 5 it grows to around $161,000. By year 10, roughly $259,000. By year 15, about $418,000. And by year 20, approximately $673,000. That's more than a 6-fold increase, a strong combination of dividend compounding and capital appreciation. The beauty of this approach is that those dividends keep growing year after year, creating a snowball effect that accelerates wealth building over time. With QQQ, assuming 12% annualized returns and reinvestment, by year 5 your investment grows to $176,000, by year 10 $311,000, by year 15 $552,000, and by year 20 around $979,000. Under that growth scenario, your $100,000 nearly becomes $1 million. That's the power of compounding in tech-driven innovation. The higher growth rate may seem modest compared to SCHD, but over 2 decades, that extra 2% makes an enormous difference in final wealth. JEPI, with a 7% annualized total return, compounds more modestly. After 5 years, $100,000 becomes about $140,000. After 10 years, around $196,000. After 15, $274,000, and by year 20, roughly $382,000. The difference is that JEPI's income stream pays you monthly. For investors relying on cash flow, that consistent distribution can be a huge benefit, even if the overall growth is slower. Over those 20 years, you could have collected more than $150,000 in distributions, which represents real cash that many investors use to fund their lifestyle or reinvest strategically. Each fund carries its own distinct personality. SCHD balances growth and income beautifully. It's composed of quality companies with strong fundamentals, offering steady dividends that can grow over time. It's a favorite among long-term investors who want to see reliable compounding without the wild volatility of tech stocks. The fund's focus on dividend aristocrats means you're investing in companies with proven track records of shareholder-friendly policies. QQQ, in contrast, is an adrenaline rush for your portfolio, highly rewarding but also capable of testing your nerves. It's concentrated in tech and innovation, meaning that during bull markets, QQQ can explode in value. However, it's also prone to sharp drawdowns. Those who've stayed invested through downturns have been rewarded handsomely, but timing mistakes can cost you dearly. The psychological challenge of watching your portfolio swing 20 to 30% in months can't be underestimated. JEPI plays a different game altogether. It's for the investor who wants to generate income, now. By writing covered calls, JEPI effectively trades some of its future growth potential for present-day cash flow. This makes it ideal for those nearing or in retirement, where the focus shifts from building wealth to maintaining lifestyle through steady income. The monthly payment schedule aligns perfectly with how most people manage their expenses, creating predictability. Let's discuss taxes and cash flow. SCHD and QQQ dividends are typically qualified, which means they're taxed at favorable long-term rates. JEPI, however, generates much of its income from option premiums, typically taxed as ordinary income, which can be higher. This makes JEPI more tax-efficient when held in accounts like IRAs or 401ks, while SCHD and QQQ can be more flexible across taxable and tax-advantaged accounts. Understanding these tax implications can save you thousands over a 20-year period. When it comes to cash flow, JEPI stands out. Investors often use it to fund monthly expenses or reinvest part of its income. SCHD and QQQ, meanwhile, build wealth through compounding. Reinvested dividends and growth appreciation are their engines. In the long term, reinvestment of dividends makes a profound difference. Even modest dividend yields, when compounded over decades, contribute significantly to total return. What's surprising is how compounding trumps yield alone. JEPI might pay you every month, but SCHD and QQQ's reinvested dividends could easily outgrow JEPI's total value over time. Volatility, often seen as a risk, can actually be an ally in growth-focused funds, like QQQ, provided you stay invested. Market dips allow reinvested dividends to buy more shares at lower prices, boosting long-term compounding through dollar-cost averaging. However, for income investors, consistency often outweighs compounding. GP's smoother returns and regular payouts can help prevent panic selling during downturns. Behavioral finance plays a huge role here. Many investors stick to their plan more reliably when they see consistent income, even if total returns are lower. This behavioral advantage often translates into better real-world results than theoretical projections suggest. Now, let's compare how each fits different investor profiles. If you're in your 30s or early 40s with a long time horizon and appetite for growth, QQQ's potential to nearly 10 times your money in 20 years makes it extremely compelling. For those in their 40s or 50s looking for balance, SCHD offers the perfect middle ground. Solid returns, lower volatility, and growing dividends that can eventually replace income. For retirees or income-focused investors, JEPI delivers peace of mind with its monthly cash flow and reduced downside risk. Risk can never be ignored. SCHD's risks revolve around dividend sustainability. Companies can cut dividends in recessions. QQQ's risks are tied to its concentration in high-growth tech. Regulation or valuation corrections can hit hard. JEPI's risk is opportunity cost. In roaring bull markets, it lags behind because its covered calls cap upside. Each ETF is shaped by a different philosophy, so diversification across them may actually be the best solution for most investors. Imagine a portfolio split evenly. 1/3 SCHD, 1/3 QQQ, 1/3 JEPI. The SCHD portion gives dividend growth, QQQ fuels capital appreciation, and JEPI provides cash flow stability. Together, they form a diversified engine that can perform well across different market cycles. This blended approach reduces the risk of being overly concentrated in any single investment philosophy while capturing unique benefits. It's also crucial to note the impact of fees. Over 20 years, even a 0.3% difference in expense ratios compounds into thousands of dollars. SCHD's 0.06% expense ratio gives it a massive efficiency advantage over the long term. QQQ's 0.20% is reasonable for its performance, while JEPI's 0.35% is on the higher side, justified somewhat by the active management and option strategy. On a $100,000 investment over 20 years, these fee differences could mean tens of thousands in final wealth. When you model how these ETFs behave under real-world economic cycles, the best ETF for you depends not only on returns, but on how you experience those returns. During the 2008 financial crisis, dividend-paying stocks recovered faster. Companies that maintained or raised dividends acted like a lighthouse in the fog. The Nasdaq fell almost 50%, but investors who stayed invested caught one of the greatest bull markets in history. In 2020, the pandemic sent QQQ crashing 30% in weeks, but it skyrocketed soon after, as tech became the backbone of lockdown life. QQQ doubled within a year if you stayed invested. SCHD fell less sharply and continued paying dividends. JEPI's income strategy would have kept monthly payouts coming, allowing investors to reinvest when everything felt uncertain. Each strategy provided a different kind of psychological comfort during that unprecedented moment in market history. In 2022, rising interest rates slammed tech valuations. QQQ dropped nearly 30% while JEPI barely blinked. SCHD quietly outperformed both thanks to its defensive dividend stocks. This highlights a key insight. The winner changes with the environment. Over 20 years, all three have a place. QQQ shines when innovation leads. SCHD shines when fundamentals matter. JEPI shines when markets chop sideways and volatility spikes. This cyclical outperformance teaches us a timeless investing truth. There's no single ETF that wins all the time, but the one you can stick with will always win over time. Consistency beats perfection. That's why a balanced approach, owning a mix of SCHD, QQQ, and JEPI, often outperforms the investor who jumps from one to the next chasing performance. The psychological stability of a diversified approach keeps you invested. Most investors overestimate how much timing matters and underestimate how much time matters. If you missed the 10 best days in QQQ over the past 20 years, your return would have dropped by nearly half. If you missed the 10 worst days, you'd be rich. But no one can predict them. The better plan? Stay invested through both. This is why buy and hold investing continues to outperform active trading for the vast majority of investors. Let's shift to psychology. Investing isn't just math. It's emotion, behavior, and discipline. The ETF you choose must fit your temperament. QQQ requires emotional resilience. Watching a $100,000 investment fall to $60,000 in a tech crash and still holding, that's not easy. SCHD offers comfort during those periods because dividends still arrive even when prices drop. That dividend check becomes a psychological anchor. JEPI takes that further, offering monthly income that smooths the ride. Behavioral economists call this the income illusion, when steady cash flow feels like progress, even if your portfolio's total value temporarily declines. It's not a bad thing. In fact, it's one of the reasons income strategies help people stay invested. If your ETF pays you every month, you're less likely to panic sell. This behavioral edge often matters more than theoretical return advantages in the real world. Let's talk about real-world outcomes. If you had invested $100,000 in SCHD 20 years ago and reinvested every dividend, your annual dividend income today would likely exceed $10,000. That's a 10% yield on cost, a reflection of years of dividend growth. QQQ's dividend yield remains tiny, but your capital appreciation dwarfs it. JEPI might still hover near that original investment size, but it could have paid you $5,000 to $7,000 per year in cash flow the entire time. Suppose your goal is to live off investment income starting at age 65. Using today's yields, SCHD pays around 3.5%, JEPI around 8 to 10%, and QQQ less than 1%. That means $1 million in SCHD might pay you $35,000 per year, JEPI $80,000 plus, and QQQ just $10,000 unless you sell shares. The catch? SCHD and QQQ will likely keep growing, increasing income potential each year, while JEPI's payouts might stagnate if markets flatten. Taxes play another silent but massive role. Dividend income from SCHD and QQQ is mostly qualified, meaning it's taxed at lower rates. JEPI's option income is usually ordinary income, which can reduce after-tax yield in taxable accounts. That's why many financial advisors suggest holding JEPI in tax-sheltered accounts like IRAS, while keeping SCHD or QQQ in taxable ones for better efficiency. There's also inflation to consider. Over 20 years, inflation quietly erodes purchasing power. Growth ETFs like QQQ act as inflation hedges because the underlying companies can raise prices and grow faster than inflation. SCHD companies also tend to increase dividends annually, protecting your income's real value. JEPI may lag because covered call income doesn't naturally adjust for inflation. That's another reason to blend strategies for comprehensive protection. Behavioral discipline remains the silent driver of returns. Many investors lose more to emotional decision-making than to fees or volatility. The temptation to sell QQQ after a crash or chase yield with JEPI can erode long-term results. Consistency and patience always win the compounding game. When researchers analyze real investor behavior, they find something shocking. The average investor earns 3 to 4% less than the funds they own simply because of emotional decisions. So, who wins after 20 years? Statistically, QQQ likely produces the highest final balance at around $979,000. SCHD's combination of income, growth, and low cost creates the most livable wealth at approximately $673,000. JEPI remains the quiet enabler at $382,000, the one that gives financial confidence through cash flow, even when markets misbehave. The smartest move? Don't treat this as a contest. Treat it as a construction project. Build your wealth like an engineer. SCHD as the foundation, QQQ as the steel frame, JEPI as the finishing layer. Together, they form a portfolio that can endure recessions, reward patience, and support your life for decades to come. At the end of the day, $100,000 is just the starting line. The real question is, how much of it will still be invested when the next crash hits? The investor who masters patience and discipline will find that whether it's SCHD, QQQ, or JEPI, the path to freedom isn't about predicting markets, it's about staying the course through every twist and turn. If this helped you rethink your ETF strategy, hit the like button, share this with someone building their portfolio, and subscribe for more deep dives into investing logic, long-term wealth design, and the psychology behind money, because at the end of 20 years, it won't be about which ETF won, it'll be about whether you did.
You know that moment when payday hits and your bank balance finally looks a little healthy? What if I told you that money could keep growing without you lifting a finger or answering to a boss? Because with just 50 grand in 2 simple ETFs, your cash could outwork your full-time salary. It's about putting your money somewhere sensible and letting time and compounding do the heavy lifting. That's where ETFs come in, exchange-traded funds. They may not sound sexy, but they are powerful tools. An ETF is basically a basket of different companies wrapped into a single investment. If one company inside the basket stumbles, the others help balance it out. The real trick is simplicity. Pick funds that make sense, give exposure to growth industries, and then leave them alone. No late nights with charts or guesses about CEOs. Just steady, boring consistency that creates powerful outcomes over years. We're stripping away the noise and focusing on just 2 ETFs. One is fiery and packed with growth. The other is calm and steady. The first one is SMH, the VanEck Semiconductor ETF. This fund is tied to semiconductors, the tiny chips powering everything. With the world advancing in AI and automation, the demand for semiconductors is not just growing, it's exploding. Every time someone fires up an AI model, chips are working overtime in the background. The entire digital universe is built on them. SMH gives you exposure to the biggest players like NVIDIA and Taiwan Semiconductor, companies leading the charge. But semiconductors are a roller coaster. When demand is high, SMH shoots up like a rocket, but downturns can hit hard. Take 2022 as an example. Supply chain nightmares and rate hikes tanked SMH. Investors felt the gut punch of their portfolios. But semiconductors aren't a fad. They are the backbone of modern life. The sector rebounded and SMH came storming back. Over the past 5 years, SMH has delivered around a 288% return. Put in $1,000 and you'd have nearly $3,800. If you had invested $25,000 into SMH 5 years ago, you'd be looking at close to $97,000 today. SMH is the wild child of ETFs, volatile, unpredictable, but capable of turning a modest sum into something jaw-dropping with patience. It's like that talented friend who sometimes vanishes only to show up later and blow everyone's expectations out of the water. You love the potential, but the ride can be tough. It's dangerous to put all your eggs in this one basket. The growth potential is huge, but the volatility can crush you without balance. The calmer, steadier fund, VU, acts like the anchor to SMH's rocket. When paired together, they create a powerful investment strategy. VUO is the reliable older sibling. It moves upward predictably and steadily, providing a heartbeat for your portfolio amid SMH's swings. VUO is built to mirror the S&P 500, a collection of 500 of the largest companies in the United States. When you own VOO, you own a slice of Apple, Microsoft, Amazon, Johnson & Johnson, Coca-Cola, Exxon, and more. You're betting on the entire American economy to keep growing, which historically has been a safe bet. VU has been the single best wealth-building vehicle for ordinary people for decades, with a steady 10 to 11% return. Boredom in investing is good. With VOO, you can live your life without obsessing over your portfolio. Think about splitting $50,000 into $25,000 for SMH and $25,000 for VOO. Your SMH side has grown from $25,000 to $32,500. Your VOO side has increased from $25,000 to $27,500. Together, that's $60,000. Just leaving your money alone reaps $10,000. Fast forward to year 5. The SMH side has ballooned to nearly $93,000, and VOO is around $40,000. Together, that's about $133,000. You didn't trade or hustle. You just let your money sit, doubling it in 5 years by doing nothing. By year 10, the SMH side has exceeded $400,000, with VOO in the mid-60s. Combined, that's about $500,000. From just $50,000, that's the power of compounding when you let it work over time. With a regular job, you earn $50,000 a year. But after taxes and bills, there's not much left. With investing, the story changes. Yes, there are risks, but the growth curve may outpace a paycheck. You're not just trading hours for dollars anymore. Your money works even while you sleep. With investments, money multiplies over time. The first couple of years may feel slow, but growth accelerates. Risk is real. Returns vary year to year, and external factors can stall growth. But a longer time horizon helps. The S&P 500 has seen many crises and still climbs. Technology continues to move forward, ensuring growth. The beauty of pairing SMH with VUO is balance. When SMH stumbles, VUO steadies you. Together, they cover both sides, the explosive and the dependable. One scratches the itch for big returns. The other soothes your nerves when things get rocky. It's like having a sprinter and a marathon runner on the same team. By the end of 10 years, your invested $50,000 has matched what a full-time job would pay in gross income over the same span. Your money doesn't need sleep, holidays, or call-in sick. It just keeps grinding, quietly and relentlessly. There are risks in investing, and pretending they don't exist would be a lie. While you can't control market moves, you can control your habits. The biggest trap people fall into is checking too often. Open your portfolio daily and you'll see nothing but noise. One week you're up 1,000, the next you're down 2. It feels like chaos. Don't let emotions dictate your actions. The secret weapon for long-term investors isn't intelligence, it's emotional discipline. Can you stay calm during the storms? Another risk is assuming history will repeat itself perfectly. The future returns could be different. That's okay. Adding small, consistent contributions changes everything. Think about how compounding works with regular investments. That's how ordinary people turn modest salaries into real wealth. Feed your portfolio steadily and let time work for you. At some point, the conversation shifts from "how do I grow this money?" to "how do I live off this money?" That's where something called the 4% rule comes in. If you withdraw 4% of your portfolio each year, the odds are high your money will last for decades. If you've built your portfolio up to $500,000, 4% is $20,000 a year. Push that portfolio to $1 million, and now you're looking at $40,000 a year. Add that to any other income streams, and financial freedom feels more achievable. Instead of worrying about vacation requests, you're deciding if you feel like going to the beach. Money starts working for you. Freedom isn't just about being rich. It's about buying back your time and choosing work you love, not just surviving. This is the quiet revolution happening right under our noses. People are realizing wealth doesn't come from grinding 60-hour weeks forever. It comes from putting money into assets that compound. Think in decades, not days. Balance patience with persistence. There will be moments of doubt. When the market crashes, it'll feel like the end of the world. But zoom out. Look at a 30-year chart of the S&P 500. Every crash looks terrifying, but from a distance, it's just a small blip on an upward curve. The people who panic and sell lock in losses. The ones who stay put, especially those who keep buying, come out far ahead. That same 50 grand you thought of as a number could produce more than your salary, not from working harder, but from working smarter. You don't need to be a financial genius to pull it off. Just start, stay the course, and give compounding enough time to do its work. Imagine yourself 10 years from now. You check your portfolio and see $500,000. You remember the day you put in 50 grand. And you smile because while you lived your life, your money was quietly building a future you once thought was impossible. Remember this, your salary pays the bills, but your investments buy your freedom. If this breakdown gave you something to think about, make sure you hit subscribe, drop a like, and share it. Let's talk ETFs, but not the kind that put you to sleep faster than a PowerPoint presentation. This isn't going to be one of those dry breakdowns that make you question every life choice you made. If you pick the wrong fund, you might find your money leaking away like socks in a dryer vortex. We're going deep into the heavyweight matchup, SCHG versus QQQM, classic growth versus tech dominance. By the time we're done, you'll understand why your choice shapes your financial future. Here's what usually happens when people start investing. They open their favorite trading app, type in best ETF, and start scrolling. They see charts, they see percentages, they see arrows, and without thinking twice, they just pick the one that went up the most last year. I used to think I was clever chasing one-year returns, but focusing on past performance alone is like using Google Maps with half the information missing. Returns are just one piece of the puzzle. You've got to pop the hood and see what's really driving these ETFs. First up is SCHG, the Schwab US Large Cap Growth ETF. Picture it as a seasoned fisherman casting a wide net across America's 750 largest companies. What makes it stand out is balance. SCHG isn't just tech-heavy. It spreads your money across various sectors, creating a sturdy, all-weather foundation. Now cue the spotlight for QQQM, the Invesco NASDAQ 100 ETF. If SCHG is a buffet, QQQM is an exclusive Silicon Valley dinner party. It focuses on just 101 non-financial giants: Apple, Microsoft, Nvidia, Amazon, Meta, Costco, Netflix, companies shaping our lives. Investing in QQQM is like buying a front-row ticket to the future with exposure to AI, cloud, and cutting-edge tech. But that concentrated power also makes it more volatile. Thrilling when markets soar, but bumpier in downturns. Now let's talk about something most investors overlook: fees. They're like termites that can eat away at your returns. SCHG charges an ultra-low 0.04%, while QQQM's 0.15% is nearly 4 times higher, compounding into thousands over decades. If two investors both put $10,000 into their ETF every year for 30 years, the one paying lower fees could end up with tens of thousands more. Cost efficiency in investing is like getting front-row concert tickets for half the price, simply because you paid attention. Owning an ETF doesn't automatically mean diversification. SCHG and QQQM appear diversified, but share many of the same top-heavy holdings. Over half of both ETFs are dominated by the same 10 mega-cap companies, which can expose your portfolio to the same risks. A bad quarter from a giant like Apple can ripple across all growth-focused ETFs, impacting your returns. The real differences between SCHG and QQQM show in the final 10 to 15% of their holdings, with SCHG including more diverse sectors. SCHG includes financials like Visa and MasterCard, and healthcare like Eli Lilly, diversifying your exposure to various growth engines. QQQM focuses on main tech sectors, offering greater volatility with substantial swings, perfect for those seeking substantial growth. SCHG delivers a balanced approach with steady returns, funding your entertainment and health advancements through diverse sectors. Both SCHG and QQQM have produced about 18% annual returns, effectively doubling investments over 5 years. However, QQQ tends to outperform over a 10 to 15-year span due to its tech-heavy focus on innovation and growth. With technology as the driving force, consider your investment strategy and your tolerance for market turbulence. But higher returns come with higher risk. The market isn't a steady climb. It's a roller coaster with sharp drops and wild turns. In 2022, inflation fears and rising rates made growth stocks less attractive. Both SCHG and QQQM took a hit. SCHG fell about 36%, and QQQM sank roughly 32.5%. This shows that growth doesn't always mean smooth sailing. Moments like that are the real test of an investor's discipline. Surviving the downswings builds true wealth. Most beginners sell during crashes, locking in losses, but those who stay the course tend to come out stronger. History shows every single crash in the last 100 years has turned into a new high. Understanding volatility is crucial. SCHG's broader diversification means it weathers downturns better than QQQM, which can be more exposed to tech sell-offs. When the market rebounds, QQQM often bounces back faster because its core holdings, like Nvidia, Amazon, and Apple, lead the next rally. How do you use this information for a smarter portfolio? The key is understanding your time horizon, goals, and emotional tolerance. If you're young with decades before retirement, volatility isn't your enemy, it's your friend. Those dips are discounts on long-term growth. If you're mid-career and can't afford to lose 40%, consider a more stable core. A 60-40 or 70-30 split might make more sense. As you approach retirement, preservation becomes the name of the game. Protecting what you've built matters more than chasing extra percentage points. You might keep QQQM as a smaller slice, 10% or 20%, to retain growth potential, while most money could sit in SCHG or dividend-paying ETFs like SCHD or VIG. The right choice isn't the same for everyone. It's about building a mix that reflects your timeline and temperament. The hardest part of investing is mastering your own behavior. The biggest threat to your portfolio isn't inflation or interest rates. It's you. Panic selling during correction and waiting for things to calm down can hurt you. The market rewards the calmest, not the smartest. Consistency beats brilliance. Investing steadily and ignoring the noise often leads to better outcomes than chasing trends. If you invested $10,000 into the S&P 500 in 2003 and stayed invested through 2023, you'd have around $70,000. But if you missed just the 10 best days in those 20 years, your return drops by nearly half. That's the cost of impatience. The worst thing you can do is panic sell at the bottom. Those moments often set up the biggest gains. Time in the market matters far more than timing the market. Focus on how long you stay invested. When you combine SCHG and QQQM, you blend two philosophies: structure with innovation and balance with potential. Markets will crash. Headlines will scream. Talking heads will predict doom. Understand how to react when things go wrong. Volatility isn't a signal to run. It's a feature of the system. Learn to see those moments as opportunities. Whether you're leaning toward SCHG for stability or QQQM for innovation, the real key is patience. Investing is about stacking base hits. Show up, month after month and let compounding do its work. There's no single winner because the right choice depends on your values, stability or acceleration. If you're the type of investor who wants to set it and forget it, SCHG is hard to beat. Its ultra-low fees and diversified sector exposure make it reliable. Surge offers consistent performance, making it the kind of ETF you can hold for decades without losing sleep. It's the steady engine of your portfolio. Because it spreads your money across many different industries, SCHG is less vulnerable to single sector meltdowns or sudden market shifts. On the other hand, if you're hungry for maximum growth, QQQM is your ticket. It focuses on tech and disruptive innovation for bigger swings. When tech is booming, QQQM tends to outperform broader growth ETFs like SCHG, offering potentially higher rewards. If you're okay with a bumpier ride and can stomach the volatility, QQQM can supercharge your returns and give you exposure to leading businesses. You don't have to pick one. The smartest portfolios treat SCHG and QQQM as teammates. SCHG gives you structure, stability, and cost efficiency that every portfolio needs. QQM adds the spark and upside potential that can make a good portfolio great. Blending them gives you a resilient portfolio that takes advantage of bull markets. Think of it like building a car. SCHG is the reliable engine, QQQM is the turbocharger. Fees are the single most underestimated factor in long-term investing. A 0.10% difference could mean the difference between retiring with comfortable or life-changing money. If you invest $10,000 a year for 30 years with an 8% return, a 0.15% fee leaves you with about $1.09 million. With a lower 0.04% fee, that amount can increase to about $1.12 million, which is an extra $30,000. Investors can't control market fluctuations, but they can control investment costs, which compound over time. Many believe owning multiple ETFs means diversification, but if they hold the same top stocks, you're just paying more. SCHG offers broader sector exposure unlike QQQM's tech focus. Together, they enhance your growth potential. Most people think they lose money because of bad investments. In reality, they lose money because of bad decisions. They panic sell during market drops. They buy into hype when things are overpriced. Your job isn't to predict those swings, it's to survive them. If you can resist the urge to sell during a 30% drop, and if you can stay invested through the noise, you'll outperform the vast majority of investors. SCHG and QQQM aren't just investment vehicles. They're behavioral tools that test your patience and reward your discipline. With the right mindset, one focused on decades, not days, they become powerful engines of wealth creation. If you want a buy it and forget it ETF with minimal fees, broad diversification, and reliable growth, SCHG is the clear winner. If you want to lean into innovation, embrace volatility, and maximize your exposure to tomorrow's companies, QQQM is the more aggressive choice. To take advantage of both philosophies, own both SCHG and QQQM. SCHG gives a calm, predictable foundation that grows steadily, while QQQM brings excitement and potential for outsized gains. Fees matter more than you think. Diversification is more complicated than it looks. Your emotions will decide your wealth. Your future wealth won't be determined by a single ETF choice, but by your ability to invest consistently and ignore the noise. Meet Helga. She's 35 years old and earns $75,000 a year. Recently, she discovered something that could transform her modest 401k into over $2 million by retirement. This isn't about chasing crypto, gambling on stocks, or quick schemes. It's all about 5 Fidelity ETFs. 5 simple building blocks that even seasoned Wall Street professionals lean on for long-term wealth. Most think retirement investing is complicated. Thousands of options lead to analysis paralysis. Decades of wisdom have distilled into these funds, working like a perfectly orchestrated symphony. These aren't random picks. They are carefully engineered to balance growth, income, stability, and global opportunity. By the end of this breakdown, there will be a crystal-clear roadmap that anyone can implement with their next paycheck. Let's start where any solid portfolio begins, with protection against market storms. When people hear bonds, they think boring and low return. But bonds protect, provide income, and serve as seatbelts in turbulent markets. Picture 2008, with the stock market crashing. Quality bond funds didn't collapse. They went up. FBND is like an insurance policy for retirement accounts, providing steady income with a current yield of about 4.5%. For every $10,000 invested, it generates around $450 a year in passive income. The real magic of FBND lies in its diversification. This is not the old-fashioned government-only bond fund. FBND holds around 4,300 different debt securities. About 1/3 are government bonds for stability. Another third are corporate bonds, which deliver higher returns, and there's a sprinkle of high-yield bonds. The team behind FBND isn't passively sitting back. They are actively managing exposure across the bond market. FBND has almost $20 billion in assets under management, with a low expense ratio of just 0.36%. FBND cushions the portfolio when equity markets stumble and generates reliable income. It's the stabilizer for retirement investors. Many investors dismiss bonds as the dull cousin of stocks, yet history shows they often carry a portfolio through turbulent times. Think of them as the sturdy foundation beneath a house, not flashy, but essential for everything else to stand strong. Without that stability, market downturns can shake confidence and push people to sell at exactly the wrong time. Fairband acts like a shock absorber, smoothing the ride when equities hit rough patches. Bonds also provide liquidity, meaning if unexpected expenses arise, there's a dependable source to tap. FIBEN's structure makes it even more reliable by spreading exposure across thousands of issuers and sectors. Retirement investing is as much about managing risk as it is about chasing return, and bonds fill that role beautifully. Without them, portfolios feel like cars without brakes, fast on the highway, but vulnerable when the road gets slippery. If FBND is the shield, then FELC is the sword. This fund delivers millionaire-making returns while most stress about volatility. Think of it as having advanced analysts select the strongest 200 companies in America, packaged inside a single ETF. Since inception, FELC has posted an average annual return north of 23%. Investors have significantly more wealth. What's driving those results? The secret sauce is quantitative analysis, screening for exceptional fundamentals. With only around 210 carefully chosen holdings, the fund managers ensure a deliberate focus on quality over quantity. ELK stands out for being both actively managed and cost-efficient. It charges just 0.18% in expenses, a rock-bottom number for its strategy. Despite a challenging year for markets, FELC managed a return above 16%, proving its strategy withstands turbulence. In a retirement portfolio, FELC serves as a compounding engine, capturing the power of America's largest companies. FELC bridges the gap between passive and active investing, filtering out weaker performers while broadening exposure. This strategy allows investors to avoid gambling on stocks or paying high fees, ensuring each dollar works harder. FELC is about disciplined, sustainable wealth building, tilted toward proven leaders for greater confidence and higher returns. There's something deeply satisfying about receiving steady paycheck from investments, and that's where the Fidelity High Dividend ETF, ticker FDV, shines. Imagine holding companies like Microsoft or JP Morgan Chase and receiving quarterly payouts simply for being a shareholder. With FDV, that's the reality. It focuses on large and mid-cap stocks with strong dividend histories. Many are dividend aristocrats, paying consistently and raising payments year after year. With more than $6 billion under management, FDV boasts a dividend yield of just over 3%. A $100,000 investment turns into about $3,080 of annual income, and reinvesting those dividends compounds your wealth. FDV has delivered over 12% in one-year returns and around 14.5% annualized over 5 years while maintaining reasonable diversification. The fund holds roughly 120 stocks, avoiding overconcentration with about 31% of assets in the top 10 holdings. FDV provides consistent income while capturing equity growth, like planting an orchard that bears fruit each season. With stability from FBND, growth from FELC, and steady income from FDV, the foundation of the portfolio is strong. Dividend investing offers a psychological boost as it creates a sense of progress with cash deposits each quarter, promoting focus on tangible income. FDV includes financially disciplined companies, helping to reduce risk while promoting growth, thus building a system of reliability. Technology is not just a sector anymore, it's the backbone of the modern economy. FTech gives investors front-row seats to the digital revolution. FTech delivered returns north of 28% over the past year alone. It's averaged more than 23% annually over the last 5 years. These results are due to capturing innovations like artificial intelligence, cloud computing, semiconductor breakthroughs, and technologies that haven't even been invented yet. FTech tracks the MSCI USA Information Technology Index, providing exposure to roughly 300 companies, including giants like Apple and Microsoft. These big tech firms are shaping the future of civilization, from AI systems revolutionizing healthcare to cloud platforms powering global commerce. This fund captures the technologies that make everything from smartphones to electric cars possible, the beating heart of progress. FTech charges an expense ratio of just 0.08%, which is practically free for the technology exposure it delivers. Over the past decade, the fund's average annual return has been around 20%, turning modest contributions into significant wealth. FTech balances stability with explosive potential, ensuring that retirement portfolios grow with the global economy. Technology drives nearly every industry, making funds like FTech essential for investing in the infrastructure of tomorrow. FTech isn't just chasing trends. It secures a piece of the innovation pipeline and ensures broad participation in digital transformation. The last piece of this five-fund strategy is the Fidelity Enhanced International ETF, ticker FENI. This fund unlocks the power of global diversification. Since inception, FENI has averaged over 22% annual returns. But beyond performance, its role is critical. When U.S. markets stumble, international markets often shine, and vice versa. That natural balance smooths out volatility and creates a more resilient portfolio. FENI invests in developed international markets outside the U.S. and Canada, using quantitative models to identify opportunities across countries and currencies. It currently holds over 300 companies, including global leaders like ASML, Novartis, and Rolls-Royce. With more than $3.5 billion under management, the fund delivers both growth and income. It carries a dividend yield of about 2.5% and posted nearly 20% returns in the past year alone. Its active management approach helps it outperform passive international benchmarks by smartly allocating across regions and sectors. Exposure to international markets also means currency diversification. When the dollar weakens, global holdings gain relative strength, providing a hedge against domestic risk. It connects investors to industries where different regions excel. Europe in renewable energy and luxury goods, Asia in manufacturing and technology hardware. FENI ensures that retirement portfolios aren't overly dependent on one country. Instead, they ride the growth of the global economy as a whole. Global diversification helps investors capture growth stories they might never hear about otherwise, pioneering breakthroughs in renewable energy, biotechnology, and advanced manufacturing. Owning FENI means having a stake in global innovators without navigating complex regulations. It's like holding a passport to worldwide opportunity. This kind of global exposure ensures a portfolio isn't limited by the success of one country, but benefits from the progress of the entire world economy. Helga allocates her retirement savings across 5 funds. 30% goes into FBND for stability and income. Another 30% flows into FELC, sparking powerful growth. 15% is set for FDV, the personal dividend paycheck that compounds quarterly. 10% goes into FTech, capturing the technology revolution. Finally, 15% invests in FENI, opening doors to global opportunities. Starting with $25,000 and contributing $500 a month, Helga could accumulate over $2 million in 30 years. Redirecting $500 a month can establish lifelong financial freedom without depending on one sector. The strategy is elegant because it covers every major base without drowning investors in complexity. It's simple, it's efficient, and it's powerful. These 5 Fidelity ETFs are not just investments. They are building blocks for financial independence, wrapped into cost-effective packages. The beauty of this strategy is its balance: growth and stability, income and innovation, domestic strength and international opportunity. Put together, they create a roadmap that takes the guesswork out of retirement planning. Every month delayed in starting this journey costs thousands in future wealth. Time is the most powerful force in investing. The earlier consistency begins, the more extraordinary the outcome becomes. Financial freedom isn't about chasing trends or timing the market. It's about building a disciplined plan and sticking with it. These 5 Fidelity ETFs make that plan accessible to anyone, whether starting with $100 or $100,000. The best time to plant a tree was 20 years ago. The second best time is today. A future self living stress-free in retirement will be grateful for the decision made now. Set up the portfolio, commit to consistent contributions, and let compounding do the heavy lifting. Be sure to subscribe, hit the notification bell, and join the community for financial strategies.